Welcome back to Metropole Television. You're still watching a Business AM. My name is Simbalaji Charles. We're still with the Said as we discuss the biggest headlines that you're waking up to as you come to the close of this year. Now, pressure is mounting on the central bank, Governor Dr. Patrick Njoroge, to regulate digital lenders. Now, the Senate Standing Committee on Finance and Budget has raised concerns over continued unregulated lending with exorbitant interest rates charged. CBK Governor Dr. Patrick Njoroge, who appeared before the committee, however, told the senators that the delay in the passage of the Banking Sector Amendment Bill has been his major setback in regulating the operations of digital lenders. Now, the Senate Finance Committee wants the CBK Governor to authorize closer surveillance of all unregulated digital lending platforms and create a monitoring unit at the CBK to monitor digital lending practices in the country. Now, digital lenders firms have been on the spot over their predatory lending practices, which the CBK governor has compared to that of Shylocks. That's it. All right. Now, just before we talk about that, let's look at what is happening in the regulated front in terms of digital lending. Let's look at what has been the average digital lending interest rates for commercial banks in the country. And that trend we're showing you right now is going to show you that if you look at where we are then, you will say that pretty much an average of about 11.85%. realistically speaking, or just 12.03%, even when it needs to be at around 13%. But over the other side, we are talking on upwards of more than 300% annualized interest rates. Sid, from what you're saying, this conversation about digital lenders, anybody supporting it will tell you they've come up with proper financial inclusion. Would you call it financial inclusion when in reality the interest rates will make you open your eyes?
Thanks, Elijah. Digital lending has grown exponentially in Kenya over the last few years on the account of high mobile penetration in the country and also ease of use of such platforms to access credit. When we look at it from a perspective of financial inclusion vis-a-vis the interest rates, as you've mentioned, I read a survey on interest charged by some digital lenders in Kenya last year showed that, most of them are charging a monthly interest rate of close to 30% or so, and which turns out to be an annual pricing rate of more than 360%.
Yes.
This is over 20 times more than what commercial banks charge for unsecured loans, with the current average standing, as you correctly pointed at, 7.85 to 12.30%, according to the CBK. But when we look at it in terms of financial inclusion, in 2017, the Financial Inclusion Organization reported that the majority of Kenyans access digital credit for business purposes such as investing, paying salaries, and to meet everyday household needs. The implications of these findings were twofold. Digital credit can help small enterprises to scale and to manage daily cash flows. And it can also help households cope with things like, medical emergencies or other unexpected emergencies that they come across. But 35% of borrowed consumption, including ordinary household needs such as airtime and personal or household goods. These are not business or emergency needs envisaged by many investment world as used for digital credit. Only 37% of borrowers reported using digital credit for business and 7% used it for emergencies. Second, the speed and ease of access to credit through mobile applications has caused many borrowers to be heavily indebted. And that's because of the exorbitant interest rates that are charged by these digital lenders. In Kenya, at least, I think 1 in every 5 borrowers struggles to repay their loan, and this is double the rate of non-performing loans. Expensive, which leads to any borrower paying back what what loans they've actually taken out from such digital lenders.
Yes.
So if you look at it from a perspective of financial inclusion and when you balance the two, as much as there's more access to credit, we have a situation whereby, the cost of the credit is so high that it kind of, it takes you out of the picture. It makes if it's for a business perspective, if you've taken out a digital loan, it makes it, more expensive for you to actually meet your ends meet, increasing your costs and possibly putting you out of business. The digital loans, even though they are for a low value, they represent a significant share of the borrower's income. And the overall use of high-cost short-term credit, primarily for consumption, coupled with penalties for late repayments and defaults, suggests that mobile-based lenders should take a more cautious approach to the development of digital credit markets.
Yes. Now, what we do know said is that, well, the Central Bank of Kenya Governor Dr. Patrick Njoroge had been calling on them to sort of review what their interest rates are, sort of asking them, can you self-regulate yourselves before I sort of push you to the wall? Well, he found a way. What we do know now is that they cannot sort of submit credit information to any credit reference bureau in the country now. Is that a proper way for him to force them to sort of self-regulate? Is that enough?
I don't think it's enough. I mean, if you look at what, somebody, let's say, you use the example of Google.
Yes.
The tech giant Google, whose Android Google app is used by digital lenders to recruit borrowers, should use the guidelines to discourage predatory lending. To continue accessing the Google App Store platform, Google had asked digital lenders for personal loans to disclose the maximum annual percentage rate, which generally includes the interest rate plus fees and other costs of a year, or the similar other rate calculated consistently as provided for by local regulatory framework.
Yes.
This was after research conducted by Hindenburg, which highlighted discrepancies in the information contained in the application's description online and the actual practices that the digital lenders go ahead and conduct. And while they require payments in a shorter time span, these digital lending apps list repayment periods that fall within Google's stipulation online, but seemingly fail to comply in the long run. The report also claimed that these apps charge interest rates much higher than what they actually advertise, and due to proper regulation, digital lenders infringe on clients' rights to privacy by accessing their customers' contacts, to call friends and families about the borrower's debt status. And if I'm not wrong, I've read up on a lot of issues whereby such digital lenders calling up your friends, your family, and using very threatening ways to try and make you repay loans where interest rates are very exorbitantly high. And when we look at this from all these perspectives, it's very important for such a space to be regulated. If there is no regulation, I mean, it's a free world for them to do what they please, and just having guidelines without any sanctions in force, or where that they're not actually policed, then we do have a problem. And when we look at loans, the
Yes.
main issue I look at is the issue of disclosure.
Yes.
Borrowers often take out loans without fully understanding the terms and conditions behind these loans. And if you see the way banks are regulated in our country, or any prudential lender in our country, such as deposit-taking cooperative societies or insurance banks, they have disclosure obligations to abide by that are put down in regulations and in the law. And disclosure should include key terms and all of the loan, the transaction fees, on failed loans, bundle products, services offered and charged for in tandem with the loan, and any of the borrower's other responsibilities or things like what an event of default would be. So it's very important, I think, to raise regulation put in place, and with the Central Bank of Kenya amendment bill, we are likely to move in the right direction of regulating this space.
Yes.
And if passed into law, at least, the Central Bank of Kenya will regulate the monthly interest rates that can be charged by any such digital mobile lenders, such as increases or any other loan charges. It will also put a limit on non-performing loans at no more than twice the defaulted credit.
Yes.
This means that the Apex Bank in our is normally how banks are regulated, like any other commercial bank. These platforms would need regulatory approval before any major changes in the products or services that they offer.
Yes.
And this issue of predatory lending is not peculiar to Kenya. I mean, as I mentioned, like somebody like Google wouldn't take the initiative to impose new rules on from their side of things to stem the tide of predatory practices in digital lending. But despite all this, several of these apps still exist, and to halt this tide of predatory practices.
Yes.
And not allowing them to share information on CRB, it does go somehow in the right direction of regulating this space, but we need to ensure that this bill, and I like the pressure from the Senate.
Yes.
The Senate's pressure is helpful in this space to ensure that this bill gets passed, and it gets passed quickly, so that we don't have instances where Kenyans are being taken advantage of. And as, if I'm not wrong, Senator Kilonzo said, we need to stop theft of funds from Kenyans' pockets.
Yes. Now, Sid, just as we clear this in 1 minute, if you may, who takes the blame here? Because I want to compare with what happened in the betting industry. You saw the speed at which the government moved. It was quite fast. Everything happened, and in just a couple of months, that industry was streamlined. Now, here's another area which is pretty much as toxic in the government's view as the betting industry, but then there's some sort of laxity. Who should be taking the blame? Is it him, or, yes, as he's saying, the National House?
I mean, it goes both ways.
Yes.
And I don't like really pointing blame at anyone, but when we need to speed up the process, and
Yes.
I like the very fact that we have a bill in Parliament and it's reached the upper house. We are showing a lot of progress in going towards the right direction.
Yes.
So I would be in no good position to actually say that the governor of the central bank is wrong, or Parliament should have acted quicker, or the Senate should act quickly. But the steps we're taking are in the right direction to ensure that this is a regulated space, and that digital lenders in our country are actually are going to be stopped from using predatory tactics to sell their products to Kenyans in our economy.
Pretty much said. Thank you very much for taking your time off your busy schedule this morning to speak to us here at Business AM.
Thank you so much, Elijah.
All right, and on that note, we come to the end of Business AM. As we know of it, good morning.